You ever get the feeling there's this huge, invisible battle going on that affects all of our money? Well, you're not wrong. But it's not fought between countries or companies. It's a fight between two birds, a hawk and a dove. And believe it or not, the outcome of their fight pretty much determines the health of the entire economy.
Now this sounds kinda poetic, doesn't it? But this isn't just a nice image. It is the perfect way to understand two massive opposing forces that are constantly at play, pulling our economic world in different directions.
Yeah, and this is way more than just some abstract theory from a textbook. The decisions that come out of this debate have a direct, very real impact on your wallet, your job, and your future. It all comes back to this.
Okay, so let's break it down. Let's meet the contenders in this big economic showdown. And you've got to understand, these aren't just, different opinions. They represent two fundamentally different philosophies on how to manage an economy.
So on one side, you have the hawk. Think of the hawk as the inflation watchdog. It's always scanning the horizon for rising prices, and its go-to move is to raise interest rates to cool things down. On the other side, you've got the dove. The dove is all about nurturing growth and creating jobs. It's willing to keep interest rates low, even if that means letting inflation run a little bit warmer. Now, a central banker isn't just one or the other all the time. Of course, they look at the data, but their philosophy can also be shaped by the era they're in or even their own personal experiences with high unemployment versus crazy inflation.
So you can see this isn't just some academic debate. For the people actually running the central banks, this is an incredibly high-stakes balancing act. And as we're about to see, if they get it wrong, the consequences can be absolutely catastrophic.
So you might be asking, how do they actually do any of this? Well, it all comes down to something called monetary policy. The best way to think about it is like a giant control panel for the economy, with a whole bunch of levers and dials they can use to try and steer the ship.
And for a lot of central banks, like the US Federal Reserve, the job is even tougher. They have what's called a dual mandate. It's a fancy term that just means they have to do two things at once. Keep prices stable, that's the hawk's job, and make sure as many people as possible have jobs. That's the dove's job. And here's the problem. The very tools you use to fight inflation can hurt job growth. And the tools you use to boost jobs can light a fire under inflation. It's this constant, relentless tug of war.
And if you want to see what happens when that balance is lost, just look at this number, 1962. That's how many South Korean won it took to buy one single US dollar during the 1997 Asian financial crisis. Their currency completely collapsed. The country was on the brink of bankruptcy. It's a stark reminder that these aren't just abstract forces. They have huge, real-world consequences.
So we mentioned that control panel. What are the actual levers and dials they can pull? How do central banks put these hawkish or dovish policies into practice? Let's pop open the toolkit.
The most famous tool, the one you always hear about, is adjusting interest rates. This one directly changes how much it costs for you and me to borrow money for pretty much anything. Credit cards, car loans, mortgages. Then they have open market operations. Sounds complicated, but it's really just buying and selling government bonds to tweak the amount of money in the financial system. They can also set reserve requirements, which tells banks how much cash they need to keep on hand. And then, in extreme situations, they can pull out the big one, quantitative easing. That's a massive program of buying up assets to flood the system with money when interest rates are already at rock bottom.
Now, to truly understand the sheer power of an aggressive, hawkish approach, we need to look back at one of the most dramatic chapters in modern economic history. It's a story called the Volcker Shock.
Picture this. It's the late 1970s, and the U.S. is being absolutely crushed by runaway inflation. It peaked at a staggering 14.8%. The economy was in chaos, people's savings were just getting wiped out day by day, and there was this real sense of crisis in the air. Something had to be done.
So in 1979, in comes this formidable hawk named Paul Volcker to lead the Fed. His solution? It was absolutely brutal, but it was effective. He jacked up the main interest rate to an unprecedented 20%. Now, the result was a deep, painful recession. Unemployment soared above 10%. But by 1983, he'd done it. Inflation was broken.
But that victory came at a huge human cost. Farmers, home builders, they were just crushed by those sky-high interest rates. Protests erupted all over the country. This quote right here really captures that intense backlash against Volcker's unwavering, hawkish stance. And listen, this is not just a history lesson. The exact same debates that Volcker was dealing with are still happening today. The central bank's decision to be a hawk or a dove directly impacts your mortgage rate, your car loan, and even your job security right now.
So the big question is, how can we know which way the wind is blowing? How can we possibly predict the flight path of the hawks and the doves today? Well, there are a few clues.
It's the question on everyone's mind, from Wall Street analysts to everyday folks just trying to plan their finances. And while there's no magic crystal ball, there is a tool that gives us a pretty good idea of what the Fed is thinking. It's called the dot plot. 4 times a year, the Federal Reserve releases this chart, and it basically gives us a little glimpse into the minds of the people making these huge policy decisions.
Here's the secret to reading it. Each one of those little dots represents one official's anonymous prediction for where interest rates will be down the road. The key is to look for the median dot, the one right in the middle of the pack. That gives you a pretty good sense of the committee's general outlook. But, and this is a big but, a word of warning straight from the Fed chair himself, the dot plot is a forecast. It is not a promise. It's just a snapshot in time. If the economic picture changes tomorrow, you can bet those dots will change right along with it.
So let's just sum it all up real quick. Hawks fight inflation with high rates. Doves boost growth with low rates. Central banks are in a constant balancing act between the two. They use tools like adjusting interest rates to manage it all. And the Volcker Shock, that showed us the painful but effective power of a truly aggressive hawk. Finally, the dot plot gives us clues, but never certainties about what might come next.
And that really brings us to the final question, and it's a question for you. Now that you know the difference between a hawk and a dove, which bird do you think your wallet needs right now? If you're worried about the rising cost of living, you might be rooting for a hawk. But if you're looking for a job or trying to get a loan, you're probably hoping for a dove. It's a complex question with no easy answers, but it's definitely something to think about the next time you hear them talking about the Fed.